This is the business black book, where billion-dollar empires are built and collapse. $11 billion. That is the amount of fake profits conjured into existence with nothing more than a keyboard, a spreadsheet, and the willingness to lie to the entire world. Most people remember WorldCom as just another .com casualty. But as we crack open the ledger, we discover something far more sinister. This was not a company that failed. This was a company that was never real. At its peak, WorldCom was the second largest long-distance phone company in America. $60 billion in market value. 80,000 employees. A name whispered in the same breath as AT&T, but beneath the surface, the entire empire was built on accounting fraud so brazen, so systematic, that it would make Enron look like a practice run. The man at the center, Bernie Ebbers, a former milkman and basketball coach who somehow convinced Wall Street that he understood telecommunications better than engineers who built the networks. He did not. What he understood was how to manipulate numbers. And in the late 90s, when everyone was drunk on the promise of the internet, numbers were all that mattered. Let me take you back to 1998. The telecom industry was in a feeding frenzy. Every company was buying every other company. Mergers were announced weekly, and WorldCom, under Ebbers, was the hungriest shark in the ocean. They acquired MCI Communications for $37 billion. At the time, it was the largest merger in U.S. history. But here is what the Black Book reveals. WorldCom did not have $37 billion. Not even close. They borrowed it. Mountains of debt, and Wall Street loved it. Because debt meant growth. And growth meant stock prices going up. Ebbers became a billionaire on paper. His personal fortune, tied entirely to WorldCom stock, ballooned to $1.4 billion. But there was a problem that would eventually burn the entire house down. The telecom bubble was bursting. By 2001, the industry was drowning in overcapacity. Companies had laid millions of miles of fiber optic cable, but there were not enough customers to use it. Prices collapsed, profits vanished, and suddenly, WorldCom had a very ugly reality to face. They were not making money. In fact, but they were losing money, badly. Now, if you are a normal company, you report the losses, you cut costs, you lay people off, you tell your investors the truth. But Bernie Ebbers was not interested in the truth. He was interested in keeping the stock price high, because if the stock price fell, his billion-dollar fortune would evaporate. And worse, the banks would come calling for the hundreds of millions he had borrowed against that stock. So he made a choice. He decided to lie. And this is where we turn to page 17 of the Black Book, where we meet the man who would execute the fraud. His name, Scott Sullivan, the chief financial officer, a man who understood accounting the way a locksmith understands locks. And he was about to pick the biggest one in corporate America. Sullivan invented a trick, a beautifully simple, devastatingly effective trick. He called it reclassification. Let me explain how it works. Every company has two types of expenses: operating expenses and capital expenses. Operating expenses are the daily costs of running a business: salaries, rent, utilities, the money you spend just to keep the lights on. These expenses, they hit your income statement immediately. They reduce your profits in the quarter you spend them. Capital expenses are different. These are long-term investments: buying a building, installing new equipment. These costs get spread out over years through something called depreciation. They do not hurt your profits as much, at least not right away. Now, here is the con. Scott Sullivan took billions of dollars in operating expenses. Normal everyday costs like paying other telecom companies to use their networks. And he reclassified them as capital expenses with a few keystrokes, costs that should have destroyed WorldCom's profits simply vanished. $3.8 billion. That is how much he hid. And suddenly, WorldCom was not losing money anymore. They were profitable. Wall Street cheered. The stock price held. And Bernie Ebbers kept his fortune. But the Black Book always reveals the cracks. By 2002, the fraud was becoming impossible to sustain. The numbers were getting too big, the lies too elaborate, and inside WorldCom, people were starting to ask questions. Her name was Cynthia Cooper, the Vice President of Internal Audit, a woman who had spent years quietly doing her job, reviewing the company's books, making sure everything added up. And in March of 2002, she noticed something strange. Entries in the books that did not make sense. Billions of dollars labeled as capital expenditures, with no explanation, no documentation, no approval from the board. She started digging. Late at night, after most employees had gone home, she and her small team would comb through the company's databases. What they found was a smoking gun. Fraudulent entries going back years. A conspiracy that reached all the way to the top. Cooper went to the audit committee of the board. She presented her findings. And on June 25th, 2002, WorldCom made an announcement that would send shockwaves through the financial world. They had overstated profits by $3.8 billion. The stock collapsed from $60 a share at its peak to less than $1. $60 billion in market value? Gone. Evaporated. 17,000 employees laid off, retirement accounts destroyed, and Bernie Ebbers, his billion-dollar fortune turned to dust. But the Black Book was not finished. Because $3.8 billion? That was just the beginning. As investigators dug deeper, they discovered the fraud was even bigger. The final tally? $11 billion in fraudulent accounting, the largest accounting fraud in U.S. history at the time. Bigger than Enron, more systematic, more deliberate. Scott Sullivan, the CFO who orchestrated the scheme, was arrested. He pleaded guilty. He agreed to testify against Ebbers in exchange for a reduced sentence. 5 years in prison. And Bernie Ebbers? He went to trial. His defense? He claimed he knew nothing. That he trusted his CFO, that he was just a simple guy who did not understand complex accounting. The jury did not buy it. In March of 2005, Bernie Ebbers was convicted on 9 counts of fraud and conspiracy. The judge sentenced him to 25 years in federal prison. He was 63 years old. He would die behind bars in 2020 at the age of 78, having served less than half his sentence. But let me tell you what the Black Book really reveals about WorldCom. This was not just about 2 men cooking the books. This was about a system that reared the fraud. Wall Street analysts, the so-called experts who are supposed to protect investors, were too busy collecting fees from WorldCom to ask hard questions. The credit rating agencies, Moody's and Standard and Poor's, kept WorldCom's debt rated as investment grade, even as the company was imploding. And the auditors, Arthur Andersen, the same firm that would collapse after the Enron scandal, signed off on WorldCom's books year after year without catching the fraud. Everyone was making money, so no one wanted to look too closely. And here is the part that should terrify you. The fraud was not sophisticated. Scott Sullivan was not using complex derivatives or offshore shell companies. He was not hiding money in the Cayman Islands. He was literally just moving numbers from one column to another. Operating expenses became capital expenses. That's it. And for years, no one noticed. Why? Because the incentives were broken. Bernie Ebbers was paid based on the stock price. Scott Sullivan was paid based on hitting profit targets. The analysts were paid based on the investment banking fees WorldCom generated. Everyone was incentivized to keep the lie going. This is the dark secret of modern capitalism. When everyone profits from the fraud becomes the business model. After WorldCom collapsed, Congress passed the Sarbanes-Oxley Act. New rules, stricter audits. CEOs and CFOs now had to personally certify their financial statements under penalty of perjury. The idea was simple. Make executives personally liable, and they will think twice before lying. But here is what the Black Book knows. Laws do not stop fraud. They just make it more expensive, because the fundamental problem, the real problem, is still there. In a world where your bonus depends on hitting quarterly targets, where your stock options vest based on share price, where your reputation is built on showing growth every single quarter, the temptation to cheat is always there. WorldCom was not an anomaly. It was a warning. And if you think it could not happen again, look at Wirecard, a German payments company that collapsed in 2020 with 2 billion euros missing. Look at Luckin Coffee, a Chinese Starbucks competitor that fabricated $300 million in sales. Look at Theranos, a blood testing startup that lied to investors, to patients, to regulators for years. The playbook is always the same. A charismatic leader. A story that sounds too good to be true. Investors who want to believe. Auditors who are too conflicted to question. Regulators who show up after the bodies hit the floor. And by the time the Black Book is opened, By the time someone like Cynthia Cooper asks the hard questions, it is already too late. The money is gone, the employees are out of work, the retirees have lost their savings. So, what is the lesson here? The lesson from page 42 of the Black Book, the WorldCom chapter, is this: growth is not the same as value. A company that is growing through acquisitions, through debt, through financial engineering, is not necessarily a good company. It might just be a house of cards waiting for the wind to blow. Complexity is often a red flag. When you cannot understand how a company makes money, when the CFO uses jargon to explain the financials, when the business model requires a PhD to decode, that is not sophistication. That is obfuscation. And most importantly, trust but NFI. The investors who lost everything in WorldCom. They trusted Bernie Ebbers. They trusted the analysts. They trusted the auditors. They trusted the credit rating agencies. And every single one of those institutions failed them. Because in the end, the Black Book teaches us one undeniable truth. In the world of high finance, trust is a liability. The only thing that matters is the numbers, the real numbers, not the ones in the press release, not the ones in the earnings call, the ones buried in the footnotes, the ones that do not add up, the ones that make you ask, wait, how is this possible? Cynthia Cooper asked that question, and she saved whatever was left to save. But most people, they never ask. They just believe. And that is how $11 billion disappears. And with that, the Black Book closes. Subscribe, and we will open the next page soon.